Today, we shall discuss the qualitative credit control measures. They are called selective credit control measures as well. So basically, these qualitative credit control measures, they are marginal requirements, regulation of consumer credit, rationing of credit, moral suasion, publicity, and direct action. We shall discuss them one by one. When we discuss the quantitative credit control measures, they were concerned with the quantity of credit. Here, today, it is not concerned about the quantity. It is the projection of this credit in various different directions. Let us begin. Now, the first is the marginal requirements. Meaning of margin. Whenever we do a business, we do it for a margin. Supposingly, I am trading in bed sheets. I buy a bed sheet for 800 and I sell it for 1000 rupees. So what am I working for? I'm working for my profit, which is my margin. Here in this case, it is 200 rupees, right? Similarly, the banks also work on their margin. Whenever we need a loan for any purpose, we go to the commercial banks. Now, the commercial banks, definitely they will be providing us with the loan with a proper rate of interest, but the main thing is that they want us to offer them a collateral. Without this collateral, any commercial bank won't give you any loan. Now, what can be the collateral? It is your choice. You have a piece of land, a building, jewelry, some other security. You have to offer it to the banks in order to avail that particular loan. Now comes the meaning of the word margin. See, if your collateral is of say 10 lakh, supposing you have a land, the market value is for 10 lakh and you offer that land for collateral. Will the bank be providing you loan for 10 lakhs? No. There has to be a difference between the market value and the loan offered. So 10 lakh is the value of your land. Will the loan be offered for 10 lakh? Never. If the collateral is for say 10 lakh, the bank may give you the loan for 8 lakh in exchange for 10 lakhs land. In this case, the marginal requirement of the bank comes out to be 20%. So we see that whenever we go for a loan, bank will keep its margin requirement, a particular percentage. It will study your case. Only then it will decide that this much marginal requirement in this particular case the bank wants. Take another example. If the collateral is 10 lakh, your security, your gold or your jewelry, whatever you're offering to the bank is for 10 lakh. If the bank gives you loan worth 6 lakhs, then the marginal requirement is 40%. How will you find it? 10 minus 6, it's 4. 4 upon 10, it's 40%. So it is up to the discretion of the bank. It may give you 8 lakh loan for the 10 lakh security. It may give you 6 lakh loan for 10 lakh security. It is for the bank to decide. What you have to do is you have to offer your collateral. So this is the meaning of margin. Without marginal money, no bank will give you a loan. Why? Because what if you don't repay it? How will the bank survive? When I gave you the example of the bed sheets, I will be working for the profit of my margin, right? Similarly, the banks also want their profit, their margin. What if I run away with the loan value? Then at least they should have some backup plan to recover that money. So they will not be giving you without the collateral, and that margin requirement they will keep in hand. So the marginal requirement is the difference between the market value of the security which you are offering as the collateral minus the maximum loan value, right? Now, a marginal requirement of 80% will give you borrowing of 20% of the price of the security, because the bank will keep 80% margin, minus it, and then 20% you can get loan. And if the margin requirement is 100%, that means that the purchaser of security, he has to pay whole price in cash. The bank is keeping 100%. So this is upon the bank, this is upon the collateral. It depends from case to case how much margin requirement the bank has to keep. Now, increase in the marginal requirement will reduce the amount that can be borrowed for the purchase of security. If the marginal requirement increases, That means you will be availing less loan, less quantity, right? So it is totally in the hands of the bank to increase or decrease the marginal requirement depending upon their discretion to how much loan they have to offer it to the people. Now, if this, how does this bank will use this marginal requirement to achieve its monetary policy? If the bank wants to discourage the investment in a particular sector, it's not interested. It has received the guidelines from RBI that not to promote this XYZ sector. Say, wants to reduce the investment in the primary sector. Now, the monetary policy focuses that let us not invest more in what? Primary sector, then what will happen? The marginal requirement of the primary sector will be increased. Automatically, to follow that guideline to reduce the investment in the primary sector, what will the banks do? They will increase the marginal requirement of the primary sector. Automatically, the investment will go down. Previously, the security amount of 1 lakh, the loan granted was 80%, say. This was the original case. In that case, marginal requirement was 20%. Now, for the security amount of 1 lakh, the loan granted will be 60,000. Marginal requirement is increased because they did not want to invest in that particular sector. In this way, the Reserve Bank shifts the funds and investment from one sector to the other sector. So, as I always say, that the magic wand lies in the hands of the RBI. So, if it wants not to invest in one particular sector, it has so many ways it will increase the marginal requirements. Now, what basically happens when the marginal requirement increases? What happens is that people will be discouraged to take loans from there. See, marginal requirement increases means people discouraged to take loans. Obviously, you will be keeping the collateral for 1 lakh and you will be getting just 60,000 in your hand. So people will say, oh, that's a very bad bargain. So what will happen? Less investment in that sector will automatically get influenced. So if the RBI wants to discourage people in one particular sector, it will increase the marginal requirement of that particular sector. So what will be the net effect? Less investment will take place, which was intentionally done by the RBI. Now, if the central bank wants to increase the funding of industrial sector, now say it wants to promote industrial sector, the reverse shall happen. What will happen? Marginal requirement will be reduced. Say previously for the security amount of 1 lakh, the loan granted was 40,000, margin requirement was 60%. Now, the security amount for 1 lakh loan granted will be 60,000 because they want to promote that sector. They want more and more funds to flow in that sector. So, the marginal requirement will be 40%. So, marginal requirement reduced means people encouraged to take loan because they will think that it's a very good bargain. So, more investment. So, whatever RBI wants to do, in which direction it wants to take the country, it can happen. This is the tool in the hands of the central bank. Increase or decrease the marginal requirement and promote the funds to the particular sector which it wants to. It wants to promote the agricultural sector, marginal requirement will be reduced for agricultural sector. It wants to promote industrial sector, marginal requirement will be reduced for the industrial sector. So this is how the funds get shifted from one sector to the other sector without letting anybody know, because they have this marginal requirement in hand in which they can direct the flow of credit. So that is why it is called selective credit control measures. Now, it is not going to implement throughout. It's not a blanket ban on all the sectors. No, it is selective. You are selecting for this 5 year, you are selecting agricultural sector. So let the agricultural sector flourish and let people get more and more loans. So this is how it happens. Now, what are the advantages of this marginal requirement wala thing? It controls the credit in the speculative areas. At the same time, it does not affect the inflow of credit in the productive areas. Now, what are the speculative areas? Speculative areas are those areas where you may have a profit, but there are quite substantial chances of losing it also. The risk is also a very high factor. Right? Now, supposingly I want to go in for a tire industry. It is not speculative, it is a productive sector. No doubt there are chances of profit as well, there are chances of loss also, which prevails in every industry, which prevails in every business. But this is not speculation. Speculation is the betting business is speculation. You may be, charmed by the profit, but if you see it economically wise, there are more chances of risk. You may lose. So those areas are called speculative areas, and the commercial banks, they control the credit in those speculative areas where they think that it is not going to work, right? They will increase the marginal requirement. So this is how the discrimination is taking place in the hands of the banks in case of speculative areas and the productive areas, which is a very good thing for the country. You have that tool, you have that tool in you in which you can direct the flow of credit towards the productive areas, and you can refrain people, indirectly or refraining people to enter into the speculative areas. If the central bank feels that the speculative activities are rising and the trade in those activities are increasing, it shall increase the marginal requirement of borrowing for these speculative ventures. This discourages the inflow of funds towards unwanted speculative areas where people stand high chance of losing. No doubt they are allured by the profit margin, but it's not good for the people. They stand to lose more than gain. So that is why this banks, they divert the funds from the speculative areas to the productive areas. Clear. Next is that the marginal requirement also helps to control inflation. Whenever there is inflationary trend in the country, what does that mean? That means that people are having lots and lots of money, the prices are rising, everybody is having pocket full of money, but you are not enjoying as an economist because everything is getting more and more expensive. In that case, RBI will raise the marginal requirement because people are already having lot of funds in their pockets to invest. So the marginal requirement will be increased. People will be discouraged to borrow more loans, and so the inflow of funds in the common man's pocket will be restricted. People will be availing less loans, less inflow of funds for investment. Automatically, the investment will come down. Less money in the hands of people, therefore your motive of inflation control is achieved. So we saw that how marginal requirement helps the banks, the monetary policy, to control inflation. Now opposite is the case, it also helps to fight deflation. Whenever there is deflation in the economy, it shall reduce the marginal requirement. During the time of deflationary trend, people don't have money. They want more and more money, and economy needs an investment booster shot. So for that, marginal requirement is reduced. People think it's a good bargain. For that much amount of security, you are getting quite a big deal of loan. People are motivated to avail more loans. More funds in the pocket of common citizen means money supply has increased. There are more ventures for investment because people will getting more funds. They will invest more. It will boost the economy. Therefore, deflation is controlled, right? Further, marginal requirement diverts the credit to productive areas. Yes, of course. To the productive areas and also for the favorable areas where central bank wants to invest. If you are sitting in a class, some students may be favorable to the teacher and some may not be. So the same way, if a particular sector is favorable to the Reserve Bank of India, it will divert its credit to the favorable sector. Now there is nothing personal in it, but here favorable I means in which the central bank thinks that this particular sector, it will help the economy to grow up. That particular sector is considered favorable here. That's why I use the word favorable. So it diverts the credit to productive activities, to the productive areas, and to the particular sectors where RBI wants to focus upon. Now, this marginal requirement also reduces the fluctuations in the market prices of the securities. Very important. The prices of securities, particularly in the developing countries, this is a very big drawback that the market prices, they keep on rising and falling. And this marginal requirement tool helps to reduce these fluctuations. Now, the marginal requirement is a very simple method of credit control as we just discussed, and it can be easily administered. So it's a very big advantage. It's not very complicated. Very simple. RBI can increase or decrease the marginal requirement of that particular sector where it wants to, and it can divert the credit from unproductive speculative areas to productive areas or towards the favorable sectors where it wants to get the money invested in. Okay. Now what will happen if there is no MR? If there is no marginal requirement? If the banks don't keep an appropriate MR, the banks will be insolvent. How will they work if they have no margin requirement? So what will happen is XYZ, everybody will go to the commercial bank. They will not be keeping the collateral, or if they are keeping the collateral, it will be lesser than the loan amount. Then what will actually happen? Everybody will take away the funds and run away. People are very smart. So the banks have to be more smarter. They will go to insolvency if there is not an appropriate margin requirement kept for any loan. If people default in the repayment of loans, the survival of banks will come to a doomsday. So see, in 2008, the Lehman Brothers case, which was an investment bank of America, it went bankrupt. It was a very big, fourth largest bank. Now it is the biggest bankruptcy. So why? Why did it happen? So these are the only clauses which the commercial banks have to keep it in mind, so that in the coming future, they don't go insolvent. They have to keep this marginal requirement. It's very important for their survival. The same scenario happened in India as well. We have been listening to the news. Every now and then this is happening. Banks, they suffer huge losses by giving unrestricted loans to people like Nirav Modi, Mehul Choksi, Vijay Mallya. They did not keep sufficient collateral. So this is what is their future going to be. So you have to be very vigilant. RBI has to keep an eye on these commercial banks, and they themselves also have to keep a proper margin requirement so that they don't come to this unfaithful future, right? Now the second point is rationing of credit. Now you must have heard that this government, they provide rations to every family, right? Now what is that? The same rice, one person may be getting it for 8 rupees per kg, and the same rice other person may be getting it for 2 rupees per kg. Why is it so? Because the person who is getting it for 2 rupees per kg, he may be below the poverty line, right? So the banks also do the same. Same rice the government is providing to two different people at two different rates. So it is creating, it is not because some are favorable to the government or some are more sweet or some are high caste. No, it's just the poverty line. They see that people who are well to do, they will be charged 8 rupees, and others, they don't have that proper income, they may be charged rupees 2. Similarly, the banks also do this. What is the meaning of ration? Ration means fix a limit, and credit means loan. So they fix a limit for loan for the various people. The same purpose. For the same purpose I'm saying here. See, in that case they were the same rice, and here it's the same purpose. Maybe I go for a tire industry loan and I'll be offered a different rate of interest, and some other person goes for the tire industry loan, he may be offered a different rate of interest. Why? Because the situation of my situation and the other person's situation may be different. The bank will study these two situations and it will fix the limit for the credit for me as well as for you. So you understand, ration means to fix a limit and credit means to take a loan. The limit will be fixed for different persons. Credit rationing is a selective method of credit control and regulate the purpose of which the credit is granted by the commercial banks. Now, see, commercial banks grant credit to every person. You have to offer a collateral, you have to present your file for which venture are you asking this loan for, right? Now, it is upon the commercial bank to give you the loan or not to give you the loan, and to how much. How much loan will the commercial bank be giving? So, this is rationing of credit which is exercised by these banks. Now, RBI aims to limit the maximum loans and advances to the commercial banks. See, the limit is fixed by the RBI as to how much loan can a commercial bank grant. You know, it can't be blindfold that, oh my God, whosoever is coming can take the loans. No, it's not like that. RBI will fix a limit that, okay, it's a commercial bank, scheduled national banks, you will be allowed to give loans, keeping in view so many things. You will be keeping your margin requirement, your collateral, blah blah blah. But the limit for that will be fixed. So it is going to fix the limit for the loans and advances. Okay. Now, second point is it also fixes the ceiling for specific categories of loans and advances. So these loans and advances will be put into many categories, and for every category, for every sublet classification, different ceiling will be fixed. This is the case of priority sector lending. The priority sectors, they will be having different limits, and the non-priority sectors, they will be definitely having a different limits. RBI may like to focus on the pharma sector or the education sector or the hotel industry, tourism, education. There are so many sectors. So wherever RBI wants to focus on, right, they will be having a liberal ceiling and others may not be. See how much loan to which sector? To the pharma sector, to the tire sector, to the rubber industry, to the education sector. How much loan? I want to run a school. I want to open a boarding school. Now, how much loan can I get? This will be different as against I want to open a pharma industry. How much loan will I get? So for every sector, there is a different classification which is made by RBI, keeping in view the monetary policy. Now, how much interest will be charged in each sector? Right, then how much subsidy will be granted in each sector? Maybe the government is focusing on the education sector and I go for availing a loan to open a boarding school. I may be getting a lot of subsidy, right? And you may not be when you are going to enter some bedsheet industry or cloth industry or something like that. So it depends upon each sector, how much loan, how much interest, how much subsidy, and on what terms and conditions. So this is different for every sector. The total lending to be increased in which sector and to be reduced in which sector, the final limit, not only the interest and the subsidy, but how much, that will also be fixed. Rationing may take these two forms. The RBI may fix its rediscounting facilities for any particular bank. It's up to RBI whatever it wants to fix. RBI may fix the minimum ratio regarding the capital of a commercial bank to its total assets. Right. Now, when the commercial banks grant loans, their ratios get changed to as regards to their capital and as regards to their total assets. So the RBI will fix that, dear commercial banks, your minimum ratio regarding to your capital has to be fixed by this much, so don't go beyond this limit. Now, ration means to fix the credit quotas for various sectors, right? Pharma industry, tourism industry, they will be getting their credit quotas, that this is a quota for you. Beyond that, not possible. It is especially important when the flow of credit has to be checked for the speculative activities in the country, right? So the speculative non-priority areas will be given different quotas, and the priority sectors, they will be given different quotas. Favorable sectors will be given different quotas, right? Rationing restricts the flow of credit to undesirable sectors and increases the flow of credit to desirable sectors. Similarly, there is not a blanket ban on any sector. It is the choice of RBI to be favorable to the desirable sectors and to get into difficult terms as regard to the interest and subsidy for the undesirable sectors. Focus of RBI on priority sectors which may be weaker, right, but essential sectors. So these priority sectors, they will be very essential for the economy. They may be for the weaker, they may be weaker, but they are very essential, very necessary for the economy as a whole. Giant business organizations, they may grab the larger chunk of the institutional credit. So it's very simple, right? Now, if Adani wants to get a loan, it will be so easy. And if I go to get a loan, it's not going to be that easy. There will be so many restrictions on me. So the larger chunk of the credit which the commercial banks offer generally goes to the giant business organizations. So this selective control measures of rationing of credit which we are discussing right now, it may help to achieve this objective of providing loans to normal citizens as well. Now, next, moral suasion. Now, the meaning of moral suasion means like morally how you will influence. Generally, parents influence their children morally, they just give you a stare, a glance, and then you understand that this is undesirable activity or undesirable talk which you are doing. So moral influence is how our elders influence us, and without openly speaking, that moral and ethical performance is demanded out of the juniors. So this is the moral suasion case of RBI. RBI advises, requests and persuades, right? It will no doubt be giving a normal advice also, request also, and pressure also on the commercial banks. The commercial banks to cooperate in implementing the monetary policy, it uses moral influence of the commercial banks. It can be advice, suggestion, request, persuasion, pressure, anything. RBI may request the commercial banks not to grant loans to speculative purposes, as we just discussed, that it can be in the form of a suggestion, right? Now, central bank may persuade the banks not to approach it for financial accommodation. So, in a way, the commercial banks, they approach whom? They approach RBI for their loans, right? It may persuade that no, this field is not good, please don't go into this. So, it can be in the form of a pressure and persuasion as well. Pressure is exerted on the banks to follow the directives. Obviously, pressure too is there. Politics is everywhere. But here I am discussing the politics. I am discussing the pressure. The pressure which is for the genuine cause for the economic policy of India. Generally, these are ignored by the member banks. These are not ignored by the member banks. You cannot, the scheduled national banks, they cannot ignore the directions which are given by the RBI, and the pressure is on them that you have to abide by and follow these rules. Instructions are definitely by the upper authority. This is a psychological method. Its effectiveness depends upon the immediate and favorable response from the commercial banks. So obviously they are not kids. You can't go these days. So you can't go to even to the nursery kids to slap them. And what about the banks? You can't go and do anything like that. But still, it's a psychological method in which the RBI tries to exert mental persuasion and pressure on the national scheduled banks to force them to follow and abide by the directions and their decisions. Now, regulation of consumer credit is number 4. See, I want to buy a washing machine. Say, for example, these days it's very simple. I can approach to any shop and pay a little amount, and the rest I can pay in installments. These days you can even buy a microwave, or the cars and all definitely are there. I mean to say, daily consumable items also, they are these days very easily available on installment system on any shop, right? So this consumer credit is also regulated by the RBI. How does this happen? This regulates the terms and conditions under which the credit is repayable in installments by the consumers for purchasing the durable goods. The durable goods, I hope you understand, it can be a washing machine, it can be a fridge, it can be a microwave. Now, when I go to buy a microwave, a little amount I'll be paying as the earnest money and the rest in installments. Now, what RBI plays the role here is, it will fix the terms and conditions on which I will be purchasing that microwave. How much installments I can take and what will be the rate of interest charged by the shopkeeper from me. So, these terms and conditions are prefixed by the RBI. As per the consumer credit system, a certain fixed percentage of the price of a durable good is paid by the consumer is in cash. I as well told you the earnest money in the beginning, the thoda sa cash you have to get it from your home, right? The rest it will be financed by the shopkeeper. You have to give your passbook and your bank details, and every month at the beginning of every month the shopkeeper will be deducting that amount from your account. So this is how it works. The balance is financed by the bank credit in which the consumer pays the installments. This is a very simple mode. I hope you people also must have done it. Now the central bank controls the consumer credit by changing the amount that can be borrowed for the purchase of consumer durables, right? Now supposing I am going to buy a washing machine of 20,000 rupees. RBI can already settle it that if a customer comes to buy it for 20,000 rupees, ask him to get 15,000 cash and 5,000 will be financed. Okay, and RBI can very well say that ask the customer to get 5,000 cash and 15,000 will be paid in installments. So that ratio has already been fixed by RBI. Now if RBI wants that every house should have a washing machine, right? So then what will you do? The earnest money or the amount which the customer has to pay in cash will be fixed very little as 5,000, 15,000 installments, okay, done. And if RBI feels the other way around that these washing machines, right, they are not a necessity. I don't like that every house should have a washing machine. Electricity bill will be increased. This will happen, that will happen. So what will it do? It will say that the earnest money has to be 15,000, 5,000 will be paid in installments. So automatically people will be discouraged to buy more washing machines, and RBI will achieve its goal of not letting a washing machine in every home. Whereas if it wants that there has to be a microwave in every home, So it will do the opposite. I hope I made the things clear, right? Now it will change the amount that can be borrowed by the purchase of consumer durables. So the magic wand again is in the hands of RBI. Changing the maximum period over which the installments can be extended. Right now, if I'm going to buy something of 20,000 rupees and I'm paying 8,000 in cash, the rest left is 12,000. What will I say? I'll say, okay, give me 6 months period. Every year, every month, I'll be giving you 2,000. But again, RBI will be the decision maker whether this 12,000 will be exercised in 6 months or I have to repay in 4 months. है ना? Every customer तो will want to get it delayed, you know, it's very easy to give 2,000 every month. So this has to be prefixed by RBI, not my discretion, not the shopkeeper's discretion. RBI controls the consumer credit. So I told you two ways. The amount will be changed for how much earnest money I have to deposit in the beginning, and the period also. How many months will the installments be carried on, right? Now this method checks the excessive demand for the durable consumer goods. Right? Supposing I live in a locality and there nobody is having a microwave, right? And I purchased a microwave, so everybody will be influenced. Oh my God, very less earnest money, very easily repayable installments. Why not I should go? A will also go, B will also go, C will also go, everybody will go. So the excessive demand arises if this installment payment system is very easy. The interest charged is very less, so everybody will move into these consumer durables. So RBI has to keep a check on the demand of these consumer durables. That is why it keeps on changing these measures, these conditions for the consumer credit. This method controls the prices of consumer durable goods, right? How does it control the prices? The interest will go high na. If you will be giving more and more installments, the ultimate price money will go increase. It controls the inflationary trends in the developed nations where consumer credit system is very popular. The developed countries, there's a very common feature here to get the goods home and get it on credit. So the inflationary trends are very well checked in the developing countries by the regulation of consumer credit. Now, next is the publicity. Publicity means the advertisements which RBI does, right? It's also a method of credit control, selective credit control. Central bank tries to educate the people regarding the economic and monetary conditions of the country. Now, you a layman, me a layman, what RBI is doing, how will we come to know? Until and unless it is publicized. You open the newspaper and if some news you get, may it be advertisement that RBI is doing so and so. So people will be educated, right? We will be coming to know of its policies and intentions and what is happening in the country. Otherwise, everybody is busy in their own business. Until and unless RBI comes forward and publicizes its monetary policies, the people, the normal citizens won't be able to understand it. So publicity very important. The central bank tries to influence the public opinion in favor of its monetary policy. Obviously, if you are promoting something, you will be doing it for your own good, right? If I manufacture tires, say, so now I will be giving the advertisement for the tires, it will be for my benefit, right? So if RBI also will be publicizing something, it will be doing it for its own benefit, right? Public opinion has to be in favor of RBI. That will be its keen interest in mind. Central bank publishes the statements of their assets, liabilities, the reports of its own activities, banking conditions. The general public anticipates the future changes in the policies of RBI by reading this public material. But there is one drawback, that this publicity and advertisement is not very successful or useful in underdeveloped nations where illiteracy prevails. There people are not able to understand it. Now, RBI कहता है जानकार बनिए, सतर्क रहिए. You would have heard it quite often in your TV ads. So this is what RBI is publicizing it. But for what? For the general public awareness, so that people don't get doomed out. They don't get bluffed out by using all these, ATMs and this online payments and all. So RBI takes a step forward and keeps on publicizing, right? Now, direct action. Direct action means directions issued by the central bank to the commercial banks regarding their lending and investment policies, as we discussed in the previous slides. It keeps on instructing the commercial banks regarding their lending, investment, interest, subsidy, everything. Now, if commercial bank ignores the rules and regulations of the central bank, then some punishable steps are taken. So, wherever you are working, if you are in a school or in a college, or even if you are doing some job, if you don't listen to the upper authorities, your seniors, the subordinates are punished a little, right? I think it's very genuine and it is must. So similarly, these commercial banks, they may have to face some punishable steps if they ignore, purposely try to default these rules and regulations. What can be these sort of punishments? RBI may charge a certain penal rate of interest over and above the bank rate on the money demanded by the bank beyond a certain prescribed limit. So they have to pay a certain penalty in case you are unfollowing the rules. Okay, if you cross your limits, you'll definitely have to listen something from your parents, which I hope you people also do. So similarly, these commercial banks also will be paying some penalties if they don't abide by the rules and regulations which are framed by the central bank. Central bank may refuse to grant more credit to the banks whose borrowings are found to be in excess of their capital reserves. I told you now, they make a ratio has been fixed to their capitals and their assets. Now, if you go beyond that, the central bank may take its own decision to say no to credit to certain commercial banks. Direct action may involve the use of force and may create an atmosphere of fear. That is obviously there. If you will charge a penalty on someone, they may little fear, but this is very important to maintain the dignity and to educate the commercial banks that you have to follow RBI. RBI is working for the benefit of the nation, for the economic stability, always for commercial banks and of course for the public and for the country as well, right? So here we come to the end of the article, selective control measures. I hope I've made the things very clear to you. In case you people have any doubts, you're more than welcome to ask me in the comment section. Please like and subscribe to my channel. Don't forget to do that. Thanks for watching. Stay safe, stay blessed.